We are in the thick of earnings announcement this week. What's a good trade that a smaller account could do for a trade? Mike Breckentein and Nick Batista put out a couple of trade ideas that I really were very interesting. One was a Tesla broken wing butterfly. The other was a Google call calendar. Let's take a look at what happened to the stocks. If we go in and look at, let's go look at Tesla first. They came out with the cherry picks around this time Tuesday, and then what happened is earnings come out and Tesla got crushed. Dropped pretty sharply there from about 246 or so all the way down to 220. Google, same thing happened. Went from about 181 down to 166. So these are pretty sharp drops after earnings. If you go back to the cherry picks video I did last week, I talked about taking risk around earnings. If you want to add risk to your portfolio, earnings are one way to do that. This is the risk I'm talking about. Earnings come out for whatever reason, good or bad or otherwise, they surprise the market. And in these cases, both Tesla and Google dropped pretty sharply. But afterwards, let's say you're a contrarian trader, you got a small account, what trades could you put on now to take advantage of that? One of the things I like to look at, first of all, is the volatility of the product. Let's look at Tesla first. They put on an unbalanced butterfly for credit, and that would have actually profited in this down move. But if I were going to initiate a trade now, volatility is about 23% IV rank. If I go in here, what if I sold a put spread, as a bullish trade? Selling a 210, 215 put spread, $5 wide, I'm looking for the target for me anyway, is to take in a credit that's 1/3 the width of the strikes for a short put spread or a short call spread. In this case, a bullish trade is a short put spread here. This is a decent one. 42 days to go. The 1/3 between 205 and 210, 5 points, is about $1.66. This generates $1.70 credit. Max loss is $330. Max potential profits $170. Again, only requires $333 of capital to put on. So I would suggest this is suitable for a smaller account in a risky stock. Looking at some of the numbers, has a 71% of making half its max profit, or about $80, $85 before expiration. That's not bad, and generates 90 cents of theta per day. If you are bullish in Tesla, a contrarian trade, after earnings, if you think the bad news is out and it might bounce back, a short put spread like this could be suitable for you. Let's take a look at Google. And the guys put on a diagonal spread. If we go take a look at that really quickly, it was called diagonal. They bought the September 185 call and sold the 195 call with 3 days. So that's basically past now. So they'd be left with the 185 call in September. That trade, yeah, that'd be getting clobbered right now because the stock is way below 185. Again, this isn't saying that there were bad trades to begin with. That's not the point. Is what I like about both those trades, they had defined risk in case they do go against you. You don't lose a huge amount of money. These are the surprises that you can get with earnings. If I were going to go back in now, let's take a look at another diagonal. Now the Google IV rank is pretty high, 41%. Let's just, for the sake of argument, let's go and take a look at some short put spreads. Maybe the 60-55, 160, 165. I'd be buying the 155, selling the 160s. $1.18. So this is where I might pass on this trade. I'm only collecting $1.18, $1.20 for that spread. My target is $1.60. Could you still do this trade? Of course you could still do it. Again, it has some pretty decent numbers too. Max loss is only 386, again suitable for a smaller account. 83%, 81% chance of making about $60 before expiration, and generates 95 cents of credit a day. But if you wanted to stick to that 1/3 the width of the strikes rule, let's go look at a diagonal like the guys did. If I go into the SEPs, what I like to do with a diagonal is buying a further dated call. In this case, a bullish diagonal would be buying a further dated call, which in this example, buying an in-the-money call with, let's say, 56 days to go in September, and then I'm going to sell closer to expiration out of the money call against it. What I like to see is the credit of the short call in the closer month offsetting the extrinsic value that I'm paying in that long option. So if I go into the 56-day options, here's what I'm looking at. If I buy the 160 call, and to figure out what the extrinsic value is, I look at the 160 put. It has about $4 of extrinsic value. That's kind of steep. That's a lot of extrinsic value to cover with one short call in the front month. And again, the 55s, so not the 155s, they have about 270 of extrinsic value. If I bought the 55s and I go in and I look at, let's say, 28 days, can I find a call to sell that generates about $2.70? Well, I could sell the 170. That's a little bit close, but you know, if it rallies up, it's not too bad. What if I went down and did the 150? So I'm buying 150s, and then I need to generate about $1.70 or so in credit to offset it. And I could sell the 75s against it. This is a trade. It's going to require a lot more capital. That's what I don't like about these diagonals here, because Google is an expensive stock. Its option prices are commensurately expensive, or rich too, or high priced, I should say. So 1,716 to do this trade. This is a diagonal that you might consider if you have more capital. Let's get out of that though. Let's go into 42 days. And this, by the way, as a trader, doing this for a long time, and I trade a lot of trades every day. This is how I cycle through trades. This is the way I do it. Something you could do too. But what if I bought the 55s and sold the, let's do the 60. If I bought the 60 call, sold the 70 call to create a long call vertical. Not bad. I don't love this trade. But 578 is a little expensive. Let's pull this up to the 65. Buy the 65s. You could do something like this. Buying the 165 call, selling the 170 call requires only $250 of capital. What I don't like about it, has negative theta, but again, it's a bullish trade. Has a 60% probability of making half its max profit, which would be about $125 before expiration. These are some strategies. Google's a little bit tougher. I like the short put spread in Tesla a little bit better. It gets me the credit I'm looking for. And again, suitable for a small account. This is another trade suitable for a small account, but I don't necessarily love the numbers. But these are trades that you could do. If you don't like taking the risk through earnings, wait till earnings get announced. See what the stock does, then enter the trade and go through the cycle as I just did. If you want to get these cherry picks delivered straight to your email every week, or my cherry bombs delivered every day with some trade ideas, just click on the link below.